Welcome to all. Today I am going to discuss do's and don'ts in investment. So there are a lot of investment avenues. You may be familiar with the investment avenues, I think. So shares, bonds, and derivatives, options, futures, swaps, and real estate, gold. So people are ready to invest all these investment avenues. But the thing is, where we invest, that is a confusion faced by the people usually. So whether they can invest gold or real estate or shares or bonds or derivatives, etc. So I'm going to discuss the do's and don'ts in investment. People usually, face some problems and some biases. So I will include all these things: how to make an investment a better way, or which are the biases we have to exclude while in the process of investment. So I have included ways to make money, goals of investment, planning investment, need of investment, diversification, impact of inflation on investment, investment biases, investment tips, etc. So investment, it is not a simple thing. It is not easy. So a matured investor or a matured investment should be needed. So most successful investors were not made in a day. So you may be familiar with Warren Buffett, very experienced investor in the world. But even the Warren Buffett suffered huge losses from his investment. So that the successful investors learning the ins and outs of the financial world, it takes time. So the personality as an investor takes time and patience. So the patience is very important. So there are two ways to make money. So people are interested to make money or create wealth. So the first way is to earn an income either by working for yourself or for someone else. So salaried people who work for an employer, so the employer gives the salary, or you can start an undertaking or a venture. It's like entrepreneurship. So the second one is, so with the high asset, the other way to grow your fortune is to invest your assets so that they increase in value over time. So we can invest in assets and we can wait for the increasing of value of those assets we invested. So we can invest in stock, we can invest in bonds, we can invest in mutual funds. It's our decision. We can invest in options, futures, precious metals, real estate, cryptocurrencies, small business, or a combination of all of the above. So we can create a portfolio by including weighted average of all these things, including the weights or proportion of all these avenues. It is not better like we invest only in equity shares. It is not good when we invest only in bonds. It is not good when only invest in gold. So we have to create a portfolio. That is what is needed. So need of investment. So why people invest? Maybe child's education, maybe buying a home, maybe child's marriage, maybe buying a car, TV, AC. But remember, an individual investment goal depends on his or her income, age, and risk tolerance. So richer people investment portfolio is different from the middle class people. Middle class people investment portfolio is different from the low income group people. And age wise is also different. So youngsters are more aggressive in investment. They are ready to take risks, so that these people are investing in cryptocurrencies. Okay, so cryptocurrency is one of the recent investment avenue. Now I would say that the youngsters are following the cryptocurrencies and crypto market, huge amount of money, so that these emotions, there are a lot of discussions going on. whether there is a fundamental backup available for the cryptocurrency market. So that the Paul Krugman, the person who predicted the global economic crisis in 2007, and he said that the cryptocurrency is the evil of the 21st century because of lack of fundamentals. So, so age-wise different, youngsters are taking more risk, but the old age people, they are not ready to take risk. So that these people invest in less risk avenues, and risk tolerance is also different. So investment is different according to the income, age, and risk tolerance. And making regular investments forces you to set aside a sum regularly, thereby helping you a sense of financial discipline in the long run. So investment create a financial discipline. A person who do not invest may face some consequences in the future. But if a person who regularly invests in or create some portfolio of investment can be benefited in the future time. So next is impact of inflation on investment. So I can say that a hypothetical example, if the inflation rate of the country is 8%, but now the inflation rate is not 8%, I can say that, hypothetically I can say that if the rate of inflation is 8%, what would be the rate of, value of investment after 1 year, 2 year, etc. So you have invested rupees 1 lakh, and if the current rate of inflation is 8%, so you may invested fixed deposit. Fixed deposit provides 8% rate of return. Again, hypothetical example, 8%. So what would be your real rate of return? So real rate of return would be 0, because 8% you getting from fixed deposit will be compensated with the inflation rate of 8%. So the 8% will be compensated with the inflation. So the real rate of return is 0. So that people are interested to invest investments providing more rate of return, right? So if you invested in the fixed, same example, same hypothetical example, invested in a fixed deposit providing 8% rate of return, after 1 year the 8% would be reduced from the 1 lakh, and rupees 92,000 is the actual value of 1 lakh, and after 2 years again 84,640, after 3 years 77,869, and after 8 years would be 51,322 rupees. So this is the impact of inflation on investment. We have to consider this inflation factor while in the process of investment. Otherwise, we would suffer from the inflation. Okay, so we have to consider some best investment avenues which provide a rate of return which would cover the inflation. So next is diversification. Diversification is a very important principle of investment. So one basket is higher risk of total loss. If anyone is like it's bad and it will affect the other eggs also. So many baskets safer, but it is costlier. We have to look carefully for each and every basket, because if we select 4 baskets, we have to consider or look the 4 basket. So it become costlier. So the portfolio, when we create portfolio would become costlier, but if we consider in one investment, it is not costlier, but it is very risky. So that the diversification is important. So we have to diversify the investment. It is not good when we invest the total amount of our investment in real estate. It is not good when we invest total amount of our funds in gold. It is not good total amount of funds invested in shares. So we have to allocate a specific percentage of investment in these avenues. So to say 10% equity shares, 10% gold, 10% mutual funds, 10% real estate. So similarly, we can plan accordingly. So this process is known as diversification. So there is a principle diversification. Do not put all eggs into one basket. So, but while in the process of investment, we have to check ourselves. Are we really rational? Are we really rational? Are we really rational? Yes or no? But I say no. I don't find a rational person, fully rational person in the world. So sometimes we are taking some irrational decisions. These decisions will affect or influence the investment. I would like to say a real example which was happened in the month of May 2021. So Tesla CEO Elon Musk said Tesla will no longer accept Bitcoins. And he was tweeted like that. So after this tweet, the Bitcoin market were crashed. So Bitcoin fell by 40% from its record high levels to $31,000 on 12th May 2021. A week ago, it was trading above $55,000. You can imagine the change happened, and a lot of investors were lost because of this tweet. So what would be the conclusion? Elon Musk tweet was created a Bitcoin crash in the market. So one person emotion, one person tweet was lead for the market crash of Bitcoin. Are the market is driven by sentiments or emotions? So we can say yes, because due to the sentiments of the tweets by Elon Musk is one of the richest person in the world, and he's owning a company called Tesla. And what was the reason that Bitcoin went crashed due to tweet by Elon Musk? So is that market is guided by the emotions or sentiments? So when you see Google trends during that time, May 12, actually if you search Bitcoin crash, and you can find that there is an upper trend of people searched the keyword Bitcoin crash. So Bitcoin crash, Google trend, and there is a connection between the selling of Bitcoin. So everything is connected. If one person has made a tweet, and after that the impact of the tweet, a lot of people were sold out their Bitcoin. So that was leading for the market crash of Bitcoin. So there is a correlation between Bitcoin price and changes in query volumes regarding Bitcoin. So there are studies. So cryptocurrency price depends heavily on social media sentiments and web search analytics tools such as Google Trends. So there are papers stating like this. So are the Bitcoin market are guided by sentiments or any fundamental factors associating with the Bitcoin market? So is the same case of in case of all the other cryptocurrencies, first generation, second generation, and third generation cryptocurrencies. So new cryptocurrencies are emerging day by day. So the youngsters are following along with the cryptocurrencies. See, so that the Paul Krugman, you may be familiar with the Paul Krugman, the person who predicted the global economic crisis in 2007 and is a Nobel Prize winner. And he said that the Bitcoin is evil of the 21st century. Why he said like this? There is no fundamental factors associated with the Bitcoin. Maybe true, there are discussions and debates going on about the future of cryptocurrencies and this main currency Bitcoin. So there are power of digital nudges. Paul Krugman still believes that Bitcoin has no fundamentals. So nudges are interventions that influence people in particular directions, but that also allow them to go their own way. So there are a lot of advertisement ads. We can say that these ads are part of digital nudges. These nudges subconsciously influence us. So we can see an artificial investment intention in the form of digital nudges playing in the field of the Bitcoin market. So I would say the youngsters are more attracted towards the crypto market due to these digital nudges. These digital nudges are the creating artificial investment intentions to the youngsters. So not only crypto market, we can see in stock market also a lot of youngsters are interested to invest in stock market. That can be seen from the, there are two brokers. These brokers are called as discount brokers, and SEBI has given license to these brokers as discount brokers. They are the part of fintech startups, Sharoda and Upstocks. And the full trading is free, so that people are interested, means youngsters are interested in trading, so that the market is, stock market is moving up. If this way stock market, it's a lot of investment in stock market coming up, the market maybe touch next ups in future because of a lot of new investment. It is not only in India, around the world it is happening. In US, Europe, every market is, you can see that market is moving very tremendous way. The index are increasing up. So there are two types of biases, cognitive biases and emotional biases. So I will explain these cognitive and emotional biases. So biases in the investment process. So one should understand these biases are coming up spontaneously and we will take decisions based on that, and when we suffer losses. So we have to control our biases in the process of investment. Otherwise, we will suffer huge amount of losses due to the bad decisions out of these biases. So there are two types of biases, cognitive biases and emotional biases. So first of all, cognitive biases, it is a type of error in thinking that occurs when people are processing and interpreting information in the world around them. For example, a situation in which a thief wears a police uniform to pass through security checkpoint. The security officer assumes the thief as a real police officer. So this, our mental process create an image that a thief as a real police officer. So this type of biases are called cognitive biases. So there are different types of cognitive biases which may arise during the process of investment. Confirmation biases. So this bias confirms on ideas only, our own ideas only, and ignoring the information that opposes them. An investor, for example, an investor who is holding Reliance Industries share, welcoming all positive news about the Reliance Industries, but he may neglect all negative news about Reliance Industries shares. This is called confirmation bias. Another one is self-serving biases. The tendency of the people to attribute the positive outcomes as skills and negative outcomes are bad luck. Okay, so usually you can find this kind of people. They always believe that the positive outcomes as their skills and negative outcomes as bad luck. For example, an investor who has got returns as expected may say increase of returns is due to his investment skills, and in case of loss he assumes that it is due to bad luck. Okay. Then there is another huge impacted biases, that is herd mentality. These many people, you know, they are, I already told the examples of Elon Musk. So after the Elon Musk tweet, a lot of investors, they have started trading, they have started selling of Bitcoin, and after that market were crashed. This is called herd mentality. Rakesh Jhunjhunwala purchased a share. Soon after that, many investors will purchase shares because of the Rakesh Jhunjhunwala purchase shares. Investors may follow things what the other investors are doing on the assumption that what the majority does is right. For example, an investor buys Reliance Industries Limited because most investors are buying Reliance Industries Limited. So this is known as herd mentality. This will influence the investment process, which is a major bias we should be avoided, the herd mentality. The negativity biases. Some investors to put more weight on bad news than the good news. So many investors have missed the bull market rally because of the fear that it will reverse suddenly. So always negative, you know, you can find this type of people. They always, you know, look for the bearish trend. The market will crash, the market will crash. They're always waiting for a crash. they are not optimistic people. They are called as pessimistic people. In real life, we can find a lot of people, fully negative. So these biases is called negativity biases. So we should avoid these negativity biases. We should be optimistic. The next is framing biases. So make an investment decision based on the way the information is presented, not on the merit of the information. We can consider two statements. You will understand better. Your investment increases by 13% over the course of the year, but loses 3% of that gain due to some year-end market volatility. So the actual rate of return 13%, but 3% was lost due to market volatility. The second statement, it is different way it is framed. Your investment increases in value by 13% over the course of the year. The market hit a rough patch near the end of the year, but you are able to hold on to 10% of your gain. So this statement is quite different from the first statement. So even though the outcomes are the same, people are more likely to prefer the statement 2 because it is presented as a gain instead of a loss. This type of bias is known as framing biases. Another one is quite interesting, bandwagon effect. So a bandwagon effect is a psychological phenomenon in which people do something primarily because the other people are doing it. Similarly, more or less similarly, we can connect with the herding bias. So regardless of their own belief, which they may ignore or override. So Warren Buffett is one of the experienced investors in the world. He became one of the most successful investors in the world by resisting the bandwagon effect. So his famous advice is an example. To be greedy when others are fearful and fearful when others are greedy. Okay, so this bias is known as bandwagon effect. And you can see a graph of the effect of bandwagon effect which happened, the increasing of the Bitcoin prices. A sudden increasing of Bitcoin prices because a lot of investors were invested Bitcoin all of a sudden and that the market went up, shoot up, right? So this is the effect of bandwagon effect. So Sensex increases by 50% from 2007 to 2008. So again is an example of bandwagon effect. So another one is anchoring bias. Anchor on the first piece of information that one receives while making decisions. So usually when we when we buy stocks, after considering the 52 weeks means 1 year maximum price and 1 year lower price. So we take a decision based on that. So a maximum price of 52 weeks, that means a resistance level, and above this level the stock won't go up because the price reach that resistance level and after that it will come down. Okay, and there is a lower price, 52 weeks lower price, and the price reaches the lower price, the price will not fall beyond this support level and the price will go up because that is the lower price of 52 weeks. Say upper price and lower price of 52 weeks, major crucial factor considering by the investors while making the process of investment. That is anchoring bias. Next is emotional bias. So I already said there are two types of bias, cognitive bias and emotional bias. Cognitive bias means the cognitive process which leads for taking of decisions, and emotional bias is a result of emotions. So emotional bias are deeply in the psychology of investors and are generally much harder to overcome. A person will be usually inclined to believe something that has a positive emotional effect which gives a pleasant feeling. So there are a lot of emotional bias. The first and most important one is loss aversion biases. So people may feel more strongly about the pain from the loss than the pleasure from the equal gain. You can find people, they are giving more emphasis on the pain rather than the gain. It may be due to psychological disposition of human beings. So feel more strongly about the pain from the loss. They are not relaxed with the gain, but they are always sad about the pain. Okay, this is known as loss aversion bias. We should avoid these loss. The next is overconfidence. In real life, you can see a lot of people, they are overconfident. When an investor feels he is superior to others in knowledge and skills, that bias arises. For example, if the price of recently bought shares goes up, then the person might get overconfident about his stock picking abilities and may invest in a stock without proper research. Okay, he is overconfident that he believes that the stock will go up and he take a decision. And you do not conduct a research on the stock because he is overconfident. So this type of biases will lead for huge amount of losses in the future. Then hindsight bias. An individual to believe that an event was more predictable than it actually was and can result in an oversimplification in cause and effect, which may lead to errors in actual situations. For example, 2008 financial crisis and the dot-com bubble of the late 90s, these two incidents stated enthusiastically about how all the signs were there and everyone knew it was coming. I already explained Paul Krugman, the person, the Nobel Prize winner, he predicted the global economic rise and the people were not taken as serious. And it was happened. The crisis was happened. A lot of people, a lot of money were lost. However, if you go back to 2007 or the mid-90s, and any analyst or investment professional and all were oversimplified and did not take a conscious approach at that time. So if they take a conscious approach, the loss would have been reduced. So this bias is known as hindsight bias. So Robert J. Schiller also conduct a lot of research on hindsight bias. He explained hindsight bias encourages a view of the world as more predictable than it really is. So it's about hindsight bias. And this is another one which part of the emotional biases, that is endowment biases. So the feeling that we do own is more valuable than what we do not. So some people are like that. We can say that the marrying of stock, they won't sell a particular stock because they are holding the stock over a period of time. They are looking the stock as just like their kids. For example, an investor might not sell a stock when the price falls because he thinks that it is valued a lot more than the current price, despite there being a solid reason for the fall in the stock price. So there are people, I would say, they won't sell some of the stocks, some of the company stocks, because even though the prices are falling, because they are loving the stock, they are just marrying a stock, they're looking the stock as just as their kids. So there are investment strategies to avoid biases. So understanding the market anomalies. So there are price differences, expected prices and actual prices. We should understand the market anomalies and take decisions accordingly. And avoid market overreactions. I already explained the example of Bitcoin crash, which was happened due to the tweet by the Elon Musk. So many investors, they were also suddenly reacted. So we should avoid the market overreactions. So do high frequency trading. High frequency trading is a new way of trading that uses automated platforms, algorithms based trading, and use of complex algorithms to analyze simultaneously many markets and execute orders in a faster and more efficient way. So these supercomputers owned and used mainly by large investment banks have changed the stock market in the last decade in a substantial way. So since millions of orders in a matter of seconds can be executed through a high frequency trading, large investment banks takes a huge advantage over normal investors. So so that the stock market, some people are saying that this is an institutions playing in the market. The individual investors cannot get a proper return from the market because these institutional investors, they have the capacity to use the algorithms and supercomputers for trading purpose. They use big data analytics and artificial intelligence for the purpose of trading. So also you can reduce the sunk cost trap effect in the market. In economics, sunk cost refers to the money that has already been spent and cannot be re-established. So it explains the tendency of people to continue with an irrational action even though it is in matching with their expectations, just because they have already put too much money or effort in it. So we should avoid this sunk cost trap effect in the market. And mental accounting, this is another bias, mental accounting. So you can see the picture. So we can ready to pay $500 tips for an expensive restaurant. Tips are a payment, but we does not pay $200 for a mediocre restaurant. So I have explained diversification. I have explained some principles of investment. I have explained the biases. So what you understand, what I can say right now is we have to avoid the biases which may arise spontaneously during the process of investment. So we have to avoid these biases while in the process of investment. So we have to have a mental soundness while in the process of decision making. And also we have to create a portfolio. We have to allocate proper weightage to all the elements, I mean all the investment avenues like gold, real estate, share, etc. in the portfolio. So there are some investment tips I would like to state. Choose investments carefully after doing adequate research. So this is important. Don't purchase a stock all of a sudden. So we have to do some research, and after the research we can understand the support and resistance level of a stock, and after that we can take a decision, and we should buy it an appropriate price. It should not be like overpriced. So we have to find the fair price in which we can buy a stock. So don't be biased, don't follow others. So we should be avoided these herding biases. So don't fall for a quick buck schemes that promise high returns in a short time. So because I don't like to say that the cryptocurrencies are like this. So cryptocurrency may be approved. The case is going on. The case is with the Supreme Court whether the approval of cryptocurrency in India. Sometimes you may experience in future all the national governments they create their own cryptocurrencies. Okay. So review your stock and mutual funds investment periodically. So we have to evaluate the stocks and mutual funds or the schemes you invested, mutual fund schemes you invested periodically. So consider the tax implications on returns you earn on your investments. What amount of taxes you have paid to government, and what all schemes which have given some exemption from income tax, etc. So keep things simple and avoid complicated investments that you don't understand. So we should invest the investment and the modes of investment. Everything should be understandable. It's like avoid complicated investments that you don't understand. So these are the investment tips I can say right now. So you can contact me. My mail ID is there. Thank you.